So when most people think about investing in real estate, at least here in the DC area, for a little person like me who doesn't have some massive real estate empire or come from a world like that, when you think about investing in real estate, you think about investing in a house and maybe flipping it, like a single property, or investing in a property and then renting it out. And it is very active, right? Because you have to go and physically either pound nails into the wall yourself and paint the place, or, so let's talk a little bit about that form of real estate investing, because it's broken up into active and passive, correct?
Correct. So, one thing when you're flipping a house, it's not really a form of investing necessarily. You're actually in the business of you're considered a dealer in most cases, so you're actually in the business of buying and selling houses. It's really no different than buying and selling cars, no different than buying and selling shoes in a shoe store. It just happens to be that the asset's very expensive that you're buying and selling. So that's more of an active business. It just gets misclassified as investing by real estate investors.
Yeah.
But really the active form of investing would be you're building a rental portfolio, buy and hold real estate. And that would mean you're going out and identifying a market that has favorable fundamentals. So the population is going to be growing, job growth is there, diversified economy. There's other factors maybe that makes that area desirable. And you're going to go and you're going to identify properties. Typically, some people most of the time people want to identify properties that they can get at a discount. Maybe the buyer is distressed and the buyer, has a motivation to sell. Maybe they're getting divorced. Maybe they can't afford it. Maybe they're facing foreclosure. Or in other cases, the property has deferred maintenance and needs a lot of work. So you go in and buy it, fix it up, raise the value of the property, and then rent it out. And then later on sell it down the line. So that's kind of the active side of it. And you're going to be responsible at the end of the day for finding that market, finding that property, putting down the down payment, getting that financing, then managing the property after the fact. So are you going to hire a property manager? Or are you going to manage it yourself? All of that comes into play when you're on the active side of the business. And, I got to say in the beginning, especially in the beginning when you're just starting out, that's going to be quite hefty. It's going to be quite a hefty load for you to carry to get that to, your first property or two properties. And then after that, it might be easier for you to scale going forward. So that's kind of the active side for most of, the individual investors. You'll be buying single family homes, maybe 2 to 4 units, maybe smaller apartment buildings. That's the type of thing you'd expect.
Now let's talk about passive investing. And we're going to talk about two different kinds, turnkey and syndicate?
Yes, syndication.
Okay. All right, syndication. Let's start with turnkey. What is that? Okay,
so turnkey investing is when a lot of that work that I just had mentioned is done for you. So, a turnkey company will find a property that has deferred maintenance or buy it from a motivated seller. They'll go in and fix that property up and then put a tenant in that property and then sell you that end product. So you, the investor, you'll buy a property that's already fixed up, already has a tenant in it. And generally, the turnkey company will remain on as the property manager. So it becomes, you still own the property, but it becomes very passive for you. And that's why they call it turnkey, because it's almost like you're just buying the property and let it go. However, when it comes to turnkey, you are still at the end of the day going to be responsible. For boiler breaks, you're going to be the one paying for it, not the turnkey company. So that's something to keep in mind. But at the same time, you still have that access and control. You still own the property. So you could, unless there's some kind of contractual obligation, you can fire the property manager and manage it yourself, hire someone else. So for people who are looking to get in on a passive side on a smaller scale and still have that access and control, turnkey is an option there for them.
All right, so then the next one we're going to talk about is syndicate investing in real estate. If I understand it correctly, this is something that really has taken off recently because of the Jobs Act. Is that correct?
So, syndication's been around for a long time. People were doing syndicates back in the 80s. So, it's been around, but it's became more popular with crowdfunding. And then, with the Tax Cuts and Jobs Act, with the introduction of opportunity funds, we're definitely going to see a rise in that type of business model on the syndication side.
And so I know a bit about the Jobs Act and how it has opened up investing like this for more people, like because of the Motley Fool Ventures Fund. Like before the Jobs Act, it probably would not have been possible for the Motley Fool to open up a venture fund and have 800 limited partners. And so in a similar way, the Jobs Act opened it up so that accredited investors have more opportunity to invest in commercial real estate.
The Jobs Act definitely opened it up to more people and allowing more people to invest. And you don't always necessarily have to be an accredited investor.
To be an accredited investor, you have to
Yeah, so to be a accredited investor, you have to, as a single individual, you have to make $200,000 or more for the last 2 years with the anticipation of making that same amount or more in the third year. If you're married, that's going to be $300,000. Or you have to have a net worth of $1 million or more, excluding the value of your primary residence, and that's whether you're married or single. So those are the two different ways you can qualify as an accredited investor. There's certain offerings that are made to what's called sophisticated investors. A sophisticated investor.
I love that. Everyone thinks they're a good driver, have a great sense of humor, and are a sophisticated investor.
Yeah, I mean, there's definitely different levels of sophistication, but basically there's something called a 506B rule. It's a regulation under Regulation D that allows sponsors or people who are going to raise the money for a deal to allow up to 35 non-accredited investors into the deal, as long as they're quote unquote sophisticated, and that's really going to be determined by the sponsor themselves and how much risk they're willing to really take on by bringing someone who they have to understand this person is sophisticated, so they have to measure that in some way. Maybe this person works in real estate, maybe they have a finance or accounting background or business background, and they might not be accredited, but they're still sophisticated enough to understand what they're investing in.
Got it. All right, so let's get into it. How does it work?
All right, so for syndication, syndication is basically when multiple people pool their money together to buy an asset that they wouldn't maybe be able to buy individually. So there's two parts of the syndicate. There's going to be the general partnership side, also called the sponsors. There's going to be the limited partners or the passive investors. And the sponsors are responsible for everything in the deal, making sure that it happens, making sure that they're identifying the market, identifying the property, identifying the business plan. Usually there's something called value add strategy, where they're going to go into a property that has that deferred maintenance or is otherwise undervalued. They're going to renovate that property over a few years and raise that property's value, then later on sell it. So they're going to be responsible for, again, just identifying the asset, making sure it's going to market, coming up with a business plan to renovate that property. They're going to be responsible for raising the financing, both from the debt side, whether that be from a bank or another institutional lender, and then the equity side was going to be usually from passive investors to be used for the down payment and renovation budget of the property. And then they're going to usually use third-party property management to manage the property and make sure that renovation goes as planned, and ultimately selling the property. And these things usually happen anywhere from 3 to 7 years is the traditional time frame of a syndication from purchase to end. It just depends on a number of factors, from the market conditions, how long it takes to get the renovation done. So that's kind of how that works.
And does it end when they determine they're going to sell the property to someone else, or what determines the end?
Yes.
Because it seems like your money, I assume your money's locked up there.
Yeah.
Or how do you get paid?
Yeah. So it depends on the structure of the deal. There's all different types of structures and how it could be done, but sometimes there's cash flow that comes out during the ownership of the property. You get distributions, and then there is also the capital gain at the end of the sale. So when the property is sold, usually when the syndication will end, and that's the two profit models. Now, two different ways to kind of make money on the syndication. Now, depending on who you're investing with and how they structure it, usually you'll see anywhere from a 6 to 10% pref with 8 kind of preferred return, which means that the investors will get paid out anywhere from that 6 to 10% annually before the sponsors get to touch any of the money, right? Before they get any profits. And then usually there's a target of 15 to 20% or more internal rate of return. So this is the kind of returns you kind of expect on these deals. Now, depending on what type of asset class you're investing in, it can vary. And these days, a lot of people investing in multifamily are starting to see those kind of rates decrease slightly, because there's a lot of money chasing a little bit amount of assets. Supply and demand is going to push the price of those assets up. And when you have to purchase that asset for a higher price, the return, the yield is going to be, of course, lower. So returns vary. And I'd have to say that if you're going to be investing in one of these things, the biggest part as a passive investor to look at is the sponsor themselves. What track record do they have? Do they have a track record of success in that asset class? For instance, multifamily or self-storage. What do other investors say about them? Who are their partners? Who are they using as their lender, their attorney, their accountants? All of this comes into play when you're determining whether or not you want to put your money with it. And it really comes down to, like Warren Buffett always says, the management team. You invest in a company with good management. It's no different here.